Welcome to REITs in a Post-COVID Landscape, a 4-part webinar brought to you by The Edge Singapore. The series is sponsored by Elite Commercial REITs.
Back everybody to The Edge Singapore's REITs Investment Forum titled REITs in a Post-COVID Landscape. Yesterday we had Matt Oakley, Director of Savills, who touched on the topic of commercial property in the UK. In our introduction, we mentioned that 17 REITs have only overseas assets. Elite Commercial REIT is one of those, and with its IPO portfolio, it has just one tenant. Most REITs would opt for a diversified tenant mix, as this lowers tenants' risk profile. Elite Commercial REIT's tenants can be said to have an AA-rated credit profile. It happens to be Her Majesty's Department of Works and Pensions, or DWP. The DWP is very much part of the COVID landscape. It's a counter-cyclical tenant and is busiest when the economy is under the most stress. Here to explain why Elite Commercial REIT's portfolio is different from every other REIT's is Shaldine Wang, CEO of Elite Commercial REIT's manager. Please go ahead, Shaldine.
Ladies and gentlemen, welcome to the Edge REITs Investment Forum. I'm Shaldine Wang, the CEO of Elite Commercial REIT. So today I'm actually going to share with you a little bit more about our REIT, how we have performed, and what are our proposed acquisitions and future plans. So Elite Commercial REIT is the first UK-focused Singapore REIT that is listed on the Singapore Stock Exchange. It is backed by a AA credit-rated sovereign tenant, which is the UK government. So 100% of our properties are leased to the UK government. Almost 100% of our properties are freehold, and 100% of our properties are actually occupied. So we have no vacancy in our portfolio. Elite Commercial REIT was listed on the 6th of February 2020 this year as the first pound-denominated listing on the Singapore Stock Exchange. Our aim is to provide stable returns and attractive recession-proof yields to our investors. The REIT portfolio consists of 97 office assets with a long WALE of 7.6 years. So all our leases are signed with the Secretary of States for housing, communities, and local governments. And the occupier is actually a department called Department of Work and Pensions, commonly known as DWP in the UK. So DWP is responsible for the country's welfare, pensions, and child maintenance policy. All the leases are on full repairing and insuring leases, which here in Asia, we commonly termed it as the triple net leases. In addition, the leases actually comes in with a built-in rental escalation that is linked to the consumer price index with a floor and cap of 1% to 5% per annum, compounded annually from 2018. So the new lease will actually kick in April 2023. Well, if you look at this chart, map here, the assets are actually located all around the UK, hence geographically it is very well diversified. The little dots represents where the properties are being located, and it is actually located mainly on the lighter grey area, which is the more densely populated area in the country. Our portfolio has been used to provide essential services by DWP. It is a crucial part of the UK social infrastructure, and DWP is a very uniquely counter-cyclical occupier. So DWP has been providing claims to more than 20 million claimants in the UK. In their financial year ended 31st of March this year, they reported that the benefits that they have been distributed contributes to £191 billion in total for the financial year. That means more than £9,000 were distributed to per claimant per year. Our properties are actually being used to provide both the front of house and back of house services to the DWP. 80 assets in our portfolio are front of house, and these are primarily known as the Job Centre Plus. So Job Centre Plus are places whereby the unemployment will claim their unemployment benefits. It is also where the job coaches will be present to help the unemployed to build a back to work plan, to go through the interviews, to do trainings, and go back to the workforce. The properties are also being used to provide pension services for the growing aging population in the UK. On top of that, there are child maintenance services and also disabled benefit services, which means some of our assets has got medical services included. And these are examination center whereby the disabled will be assessed on their work capability. 17 of our assets are actually back of house properties. So these are the back offices whereby it will provide claims processing, fraud detection and investigation center, call centers, etc. One of our property in Blackpool is actually the brainchild for the Universal Credit Program, which is the online payment system of DWP. In addition, we also have a property in Glasgow that is the only passport office for the entire Scotland. So fundamentally, our assets are very well located. 100% of them is being occupied, and it's actually around mainly town centers and city centers in the UK. The properties are very much accessible. Well, that's because the country actually requires that the Job Centre Plus has to be within walking distance to public transports. And the government pledged that people should be able to reach a Job Centre Plus within 25 minutes of public transports. Hence, the portfolio are very close to amenities as well. If you look at the statistic here, it's actually surrounded by schools, medical centers, retails, and also F&B outlets. These are actually some key criteria when properties are being chosen as investments properties. On this slide, I would like to share with you who our sponsors are. Mainly, we have 3 sponsors for the REIT. One is Elite Partners Holdings, 2, Holy Group, and 3, Sunway RE Capital. Elite Partners Holding is a fund investment company which is backed by a team of experienced private equity and real estate professionals. Holy Group is actually involved in real estate development and construction related businesses. They are also the sponsors for Viva Industrial Trust back in 2013. Sunway RE Capital is a wholly owned subsidiary of Sunway Berhad, which is listed on the Malaysia Stock Exchange. They are one of the largest conglomerate in Malaysia that has businesses that covers not only real estate development, township developments, construction, and it also covers areas such as healthcare, education, etc. So, coming to how we have performed since listing. We are actually very pleased to announce that despite the unprecedented situation that we are in now during this pandemic, we are actually able to announce that we have outperformed all our promises during IPO stage on our financial matrix. These are the key things that investors are very concerned with, such as the DPU, the cost of debt, and also our leverage. The REIT has been listed just before the COVID onset. We have actually debuted with 3.7% above the IPO price on the first day on our unit price. And since then, we have been trading well above the STI index and also the FTSE S-REITs index. Well, the pandemic situation across the world has not subsided. It has put a lot of stress onto the macroeconomic environment on the globe. Especially this is very evident by the growing unemployment rate that we see across all countries. Definitely UK is not being spared from this. And if you can look at this chart, there is actually a sudden increase in unemployment claims for more than 2.2 times to reach 2.7 million people by August 2020. So with this, the government has actually pledged to put in more resources to help the people to get back to work. And that means DWP is getting very busy as well. Hence, our tenant is very uniquely countercyclical. When the economy is not doing well and unemployment rate is up, our tenant is actually more busier than before. With that, the government has also been paying their rent on time and in full. Hence, we actually has been able to report consistently that we have collected almost 100% of rent within 7 days from the due date. Apart from this, The manager has been working on its asset management work since listing. So the aim is to try and remove as much break options in our leases as possible, with that to provide a valuation uplift. For the past few months, we have been able to work on 2 assets and has completed this option break or extension of options, and has since been able to announce that to the investors. We will continue with this, and hopefully we can get more break options and lease renewals done within the next couple of years. Well, people has been wondering during the pandemic situation when the manager is not being able to travel, what happened to the assets? Now, we are quite pleased to say that we are able to engage someone which has got high experience in local asset management, especially working with the DWP estates in the UK. So James has joined us before the onset of the COVID, and he, together with the team here in Singapore, has been holding regular and direct dialogues with DWP and also with the government property agencies to understand what's the needs of the government. So the REIT has been able to provide a very consistent return to its unit holders. And considering the similar kind of credit backing, which is the UK government, Elite Commercial REIT has been able to provide an average yield that is actually more than 690 bips above the 10-year UK's government bonds today. In addition, the portfolio also comes in with the built-in rental escalations, which means that the rental growth will become realized when the uplift happens. Hence, that's something that's quite different from government bonds returns as well. Building on our existing strategy, we have recently announced that we will be proposing to acquire a portfolio of assets. This proposal includes the acquisition of 58 commercial properties that are leased to the UK government. The assets are actually part of the ROFR assets which the sponsors has provided. It is valued at approximately £212.5 million, and it is leased to DWP and also 5 other UK government entities. So 100% of the assets are leased with an average WALE of 7.4 years. The transaction has been structured in such a way that we need to ensure that is actually completion certainty in this transaction. Hence, the vendor has agreed to take up some of the consideration units as payment for the acquisitions. So up to £89.4 million of consideration units will be issued to the vendors, which are unrelated third parties, at a minimum price of 68 pence. This particular acquisitions also see the introduction of London assets into our portfolio, which managers thinks this is actually a very important growth path. London is definitely somewhere where we want to see our properties to be located. So in summary, the rationales for the proposed acquisition that we are proposing forward is: 1, we are able to extend the REIT's exposure to UK sovereign credit with a diversification of occupier mix. So other than DWP, we have 5 other government entities coming in as tenant. It provides a stable cash flow and a CPI index growth from the uniquely countercyclical occupier DWP, which remains as the key tenant to the REIT. We will see an increased exposure to London, with 36% of the assets to be acquired located in the London city. This acquisition will bring the AUM of the REIT to close to 1 billion Sing dollars, which is quite a crucial mark for the REIT growth path. With this, we expect to see a growth in market cap, free float, and hence assist in other liquidity of the stock as well. The DPQ accretion as estimated under our base case is 3.2%, and this is an attractive use relative to our existing portfolio. As mentioned earlier, the main tenant is DWP, which constitute to 82% of the gross rental income. The other government departments that are coming in are namely the Ministry of Finance, National Records of Scotland, Her Majesty Courts and Tribunal Services, Natural Resources of Wales, and also environmental agencies. So this gives us the diversity in terms of occupier mix. Now, DWP remains as the key tenant to elite commercial REIT. With the surge in unemployment since the start of the COVID, the government has since announced that they will increase the number of work coaches by doubling the existing work coach and workforce of 13,000 people to 27,000 people by March 2021. DWP, being an essential services to the government, also remains open despite the pandemic and the lockdown in London City and across UK. So which means that with the increase in the work coaches, there will be more space required by the government, and hence the increase in footfall in Job Centre Plus as well. As mentioned earlier, 36% of our properties will be located in London under this particular proposed acquisition. London properties definitely have a higher value, growth potential, redevelopment potential, and also liquidity than any other parts of the UK cities. All the properties that are actually proposed to be acquired in London are freehold. They are on straight 10-year leases, which means there's no break options within the leases, all the way till March 2028. With this lockdown and pandemic in the UK, we see that London is the city whereby it has the largest increase in unemployment claims since January. It has reported more than 130% increase by August 2020, compared to only about 100% increase in regional cities. So these are where the properties are located in the London city itself. Is quite well spread across the north, south, east, west of London. We will provide a couple of examples in this properties portfolio. And of course, these are quite similar to the rest of the properties that we have acquired in the portfolio and to be acquired as well. So the first example is actually a property in Medina Road in Finsbury Park. So Finsbury Park is actually well known for the Emirates Stadium, which is the home ground to Arsenal Football Club. It is about 2 stations away from King's Cross. The property itself is located at the area whereby it's actually very close to a couple of the underground tube stations. It's also close to rail stations as well. The property itself is collecting a passing rent of £18 per square foot per annum. As you can see in the picture, it's a very short building which has just got 2-story high. Hence, the property actually has got excellent redevelopment potential in the future should the government move out of this property. Now, comparing to the leases in the surrounding area, which is collecting at about £36 per square foot per annum, and if it compares to properties that are leased out in King's Cross, which is collecting at more than £65 per square foot per annum, there is actually a huge difference in terms of rental collection. The reason is that the government requires functional building that are affordable to them. Hence, that means that the government will be unlikely or will be difficult to move to other locations as the price will be quite different in terms of rental. So we have a very sticky tenant here, which is looking to stay with us for a long term. So the second example that I'm showing here is actually a property in Stratford. Stratford is located in the East London location. It is actually the second most significant business location in the city after Canary Wharf. So the building is located close to where the Olympic Stadium is. It is also very close to the train station, Stratford Underground, and also a newly developed Crossrails, which is to be up and open in 2022. The property is let out at £24 per square foot per annum, whereas the surrounding properties are currently leasing out at about £28 per square foot per annum. And in the picture, you can see that it's actually just a 3-story building Comparing to the assets in the surrounding area, it definitely has got potential for a couple of more stories and also potential for redevelopment usage as well. Diagonally opposite the building is the Westfield Shopping Centre, which is one of the largest retail centres in the UK, in London itself. So this proposed acquisition, as mentioned, will increase the valuation of our portfolio to close to almost 1 billion Sing dollars or 530 million pounds. In our base case, we will see that the market cap will be increased by 57%, and the DPU reported on this base case will be 3.2%. If you look at the yields of this acquisition, we do not have London assets in our current portfolio. Hence, comparing the regional properties that we have, the new acquisition will provide a 70 bips increase in our net rental yield. And the London assets are providing 4.3% rental yield, which is very decent for London located properties. So the manager will continue to aim to buy good assets and accretive assets for the REIT. This is just a summary of how the acquisition will be done. But what we would like to highlight is that there are some very specific points about this acquisitions that we would like to share with investors. Well, as these assets are currently housed by a fund, which is managed by Elite Partners Holdings. Although it is not owned by any of the sponsors, it constitutes a related party transactions. Hence, two valuations were obtained and the price is agreed upon based on independent valuations. The transaction has also been structured to ensure that there is deal certainty. So the payments will be done via partly issuance of consideration units, as mentioned earlier. With this consideration units issuance, we actually will introduce a new significant unit holder into the REIT, which is currently also a unit holder of the REIT. This particular investors is known as Partner Reinsurance. It is actually a global reinsurance company that is owned under the Milan-listed Exor Group. Exor Group is owned by the Anelli family. There are some of the more well-known brands that they own under the group, such as Ferrari, Fiat, Giovanni's, and also The Economist. This particular acquisition will see Partner RE holding up to 21% units in the REIT itself. And hence, Partner RE has shown that they are in together with the REIT for a long term, and hence has actually went above what is required by an investors. They have provided a voluntary 6 + 6 months lockup on all the units that they have received as consideration units in the acquisition. Partner RE is a A+ rated S&P company. So with this, we will see that this particular transaction not only brings in new acquisitions, but also brings us institutional investors into the registers who are in for a long term. The transaction costs and expenses is totaling to be about £28.5 million. We will be funding it via borrowings of up to £96 million, with the issuance consideration units of £89.4 million and £3.1 million of internal resources and fees to be paid. We expect that on the base case scenario, the REIT would like to proceed with an equity fundraising of up to 30 million. However, having said that, the manager is also cognizant that any fundraise has to be well placed for investors. So we will only consider the EFR should the market be conducive. With this particular transaction scenario, we will see that the accretion of the DPU will be 3.2% and the REIT's aggregated leverage will reach 37.7%. So with this, we also would like to share with you just a few points of our future growth strategy as well. So the manager will continue to grow the REIT via acquisitions. that will include not only the off-market transaction, but also the on-market transactions where we can seek in terms of opportunities in the market, and also any ROFR pipelines that are provided to the REIT itself. The tenant that we are targeting are the UK governments that are providing key social infrastructure to the country. So on top of DWP, some of the other potential tenants that we would like to include into our portfolio includes the National Health Services, NHS, the HMRC, which is the tax authorities in the UK, and probably some education related sectors that is actually under the Ministry of Education as well. Apart from acquisition, the REIT managers will actively look at lease negotiations and try to remove as much break clauses as possible in our portfolio leases. We expect that with this, it will materially increase the valuations of the portfolio and hence provides an increased debt headroom for future growth as well. Okay, so I come to the end of my presentation. Thank you everyone for spending time with us today. And if you have any questions, please feel free to contact us at the website and email that is listed below. Thank you.
Thank you for watching today's session. Do submit your questions on the link below, and we will strive to answer all of them during the panel discussion, which will be conducted in Zoom on 21st November at 2 p.m. Please tune in then, and we will see you tomorrow.